Hey everyone, and welcome back to another portfolio update. Since it's been 2 weeks since the last one, and the performance of the portfolio has been actually extremely good. I mean, the last 3 months, the portfolio is up 16%. In the last month, it's up 10%. And since we started the challenge, since we started this specific portfolio, we are up 14.68% compared to the S&P 500, which is up 15.04%. Now, if you've been following this challenge since the start, you know that we've come from far, far away. Back here, August 5th, right? That Black Monday, August 5th, the portfolio was down 7.8%, while the S&P was up 4.15%. Again, since we started the portfolio, not since the year started. So we went from negative 7.8% to now 14.68%, whereas the S&P 500 went from 4.15% to 15%. Again, good performance. We've got some solid momentum for the overall market. But as I've been saying, there will come a time where my portfolio will just accelerate. And that's exactly what we have seen in the last couple of weeks, actually in the last 3 months. Since in the last 3 months, I'm up 16%. As you can see right here, I'm up 16% in the last 3 months. S&P 500 is up 4.79%. Now, I'm not here to say, oh, I won. No, I'm still trailing by a little bit. It's great to see that we have caught up to it almost, right? But I'm not measuring my performance for 6 months. Same as the first week, the first 3 weeks, the first 3 months. No, the performance was good, then it was bad, got even worse, then it got better and better and better. But who cares, right? That's what I love with investing, especially as a retail investor. And that's basically the topic of this video, I guess, is the fact that I don't have to show clients how are we performing. I am my own client. You are your own client. If you're a retail investor, it's your portfolio. You're investing for your future, for your family, for your kids, for your pension, etc., etc. So the only person you have to look in the eye and say, oh, I screwed up, or, oh, we did actually very, very good, is yourself. Me now looking at this portfolio, by the way, this is not the main portfolio, this is a second one that we started just this year. The main one was started in 2016, and of course, since 2016, most of the companies that I own and most of the tech companies are up and the market is up by quite a lot. But okay, that's a story for another day. This specific one is doing well, but for now, maybe a month from now, we're going to look back and say, oh, actually, it's now only up 7%, or it's now only up 8% because, market momentum got completely lost. Earnings season, some of my major positions here, Tesla, were now at $260, right? Tesla is up in the last month or so. Tesla is up 21%. Now, year to date, it's up only 4.8%, but we know that in the coming weeks, important events for Tesla, earnings report and the robotaxi event. If it does not deliver, the stock will definitely go down. Now, I expect Q3 deliveries to be quite good, better than feared. But yeah, a lot can change. We've got solid momentum, especially for me with the stocks that I own here. Palantir. Palantir is my third largest position in this portfolio. Last month, it's up 17%. Year to date, it's up 114%. So that definitely helps, right? PayPal. PayPal was a stock that was struggling, that was basically dragging the performance of the portfolio down. But I kept on saying the same thing. It's fine. Okay. We're not doing well for the portfolio. PayPal is my second largest position, hasn't done much this year. But when it will start to move, you will see that reflect in the portfolio. And that's exactly what has happened. Now, year to date, PayPal is up 26.8%. In the last month, it's up 7.5%. So we've seen some solid momentum for these types of companies. SoFi, for example, is one of those stocks that have yet to do anything for me in this portfolio. It's the fourth largest position in the portfolio. Year to date, it's down 20%. Over the last month, it's basically flat, where everything else has gone up. So this is still a position, a big position for me, the number 4 in the portfolio, that is dragging my portfolio down a little bit. Imagine if SoFi did have the same momentum as the other stocks, then I would definitely have outperformed. But again, I don't care. Of course, I would have loved everything to be up 100%, like Rocket Lab, for example. Now, Rocket Lab is a tiny position in the portfolio, but we are already up 126% on that position. Now, that's great. Again, it helps the performance, but still it's still a small position. So it helps the performance, but by a little bit. But as I've said from the start, these are long-term positions that could or could not work out. Throughout the years, I will accumulate more and more shares as my, let's say, or as the probability of success increases and risk decreases. Now, how do you know? How do you know that suddenly that happens? Well, you know, by listening to management, by seeing the milestones that are being achieved, profitability is going to get achieved. You have to keep track, of course, of those companies. If you do not want to do that, then just buy an ETF, buy the index. That's way easier. But going back to the point of being a retail investor, going back to the point of being a long-term investor, it's great to see short-term profits on paper because I'm not selling anything right now. Maybe I will, maybe I won't, but currently I have no plans on selling anything here. I might even add a little bit of cash going into the earnings season. But there are some positions here where I feel very, very confident that they will do well in the future. Now, again, this is just my opinion. We don't know what might happen in the future. But being comfortable with what you own is already a big, big plus in investing, especially for retail investors, because now things are doing great. I've tweeted out, I think a week or so ago, look at your portfolio, you're probably up by quite a lot. My portfolio has been reaching all-time highs each and every day because the companies that I own, especially the top 5, make up the majority of the portfolio. They've been doing quite well. So I'm looking, all-time highs each and every day. Keep that feeling in mind the next time we have an August 5 event when everything is down 5-10% or so, and suddenly your portfolio is completely obliterated on that day. Because on that day, that's the day where you have to be calm, when you have to sit on your hands and tell yourself, actually, you know what? Why am I stressed? Do I plan on retiring tomorrow? Do I have to report my earnings, my performance to a client tomorrow, next week, next month? No, it's me. So what do? You look at your portfolio and you say, is there any company that I wanted to increase my position in? Yes, okay. Which one? These are the companies. Okay, what happened? Is it company specific? Is that the reason why it's down, or is it market specific? If it's company specific, go and have a look. For example, DOJ sues Visa. Okay, stock is down a little bit, but is that a reason to not buy Visa on the dip? Or is that a reason to sell Visa if you have a position in that? Probably not, right? Probably not. We've seen this story play out again and again. Same with Google, right? Google, with everything that's been happening with that company. Year to date, it's up 17.3%. It's trailing the S&P 500 since the start of this year, because I think the S&P is now up 21% or so. Alphabet only up 17.37%. Also, lawsuits, Gemini AI, search, etc., lots of things surrounding Google. But we've talked about that. A breakup, also potential, which again, I don't see it happening, but okay, you have to take that into consideration, etc., etc. But these are the times where you look at the stock, you then look at the company, and you ask yourself, does it make sense? Should I add more? Or should I just skip it and go to something else? Because that's also definitely an option. Now with Alphabet specifically, we talked about this, we looked at it, and we said, doesn't make much sense, right? So we added, and we added, and we added. Now, of course, we're not doing quite well, right? In the last month or so, it's also flat. It hasn't done much. I mean, we've been higher. We've been at around $190. We're now at $163, $164 or so. Could we do better? 100%. Again, earnings season coming up. I think we're going to see quite a lot of activity in the portfolio and in the markets because, a lot of companies are priced to perfection or close to, which again goes back to the point of you have to think long term. You do not have to show your numbers each and every year to one of your clients. No, it's your portfolio. If you are a trader, you trade options or you day trade, it's up to you. If you're a short-term investor, if you want to go on, retirement next year, in the next 2 years, of course, it's completely different. Me, I plan on investing for decades. So I have a completely different view. If 1 year I underperform, then I underperform. But if I can keep on accumulating more and more shares of great companies, I'm not saying all of these companies will stay in my portfolio for the next decades or so. No, maybe some of these positions will be failed investments. Could very well be. I know some of you think Celsius is a bad company, might never work out. Okay, I mean, it's the 11th position in my portfolio. I'm down 35% on that. Does it hurt the portfolio that much? No, not that much. It hurts it a little bit, but I'm fine. That's why positioning is also an important thing. Lululemon, same thing there. And I already admitted my mistake with Lululemon, I think 2 weeks after I bought it. I just bought it way too quickly. Yes, it did go down extremely quick, but lower can go lower. Lower can go lower. And so Lululemon, yeah, I'm down on that position 17.48%. Do I think it's a bad company? No, I don't think it's a bad company. I think it could recover, but probably it will take more time than previously expected. And no, I don't expect to keep Lululemon forever and ever. Then we have turnaround plays. Something I apparently like to do is buy companies where I believe there is going to be a turnaround. The peak example here is probably Intel, right? With Intel, I've been talking about Intel for quite a while. Yes, here again, maybe I opened a position too quickly with Intel. Okay, it happens. I'm not here to time the market. I'm here to spend time in the market. Intel year to date is down 52%. Me personally, I'm now down 19.73%. Now, if my thesis plays out and if the roadmap plays out that Pat has put up, then yeah, I think I'll be in the green in a couple of years. Maybe next year, maybe the year after that. But I think that if they manage to turn it around, Intel will not be a $100 billion company in the future. Intel will be a multiple $100 billion company in the future. That's the investment I'm making. Not that, oh, I might be right by 10% or so. No, I'm buying these turnaround stories because I think that if they are successful and turning the whole thing around, then it's going to be an extremely successful investment. These things take time. That's the difference between a long-term investor and someone that will need probably this money next month, next year, maybe even the next 2 years or so. Because then an investment like Intel is definitely not for that portfolio because time is not on your side. Well, especially not with Intel, definitely not. So you skip it and you go to something else. Another example here is dLocal. dLocal year to date is also down 55%. Now here the story is a little bit different because dLocal is profitable, still growing fast, but since it is now investing in its business, then in the short run margins are getting hit. Plus it deals in maybe riskier markets as well. And so, well, the stock market is not as confident as before. And then, yeah, the stock got hit quite hard this year, down 55%. I'm down 21% here. But the same story with dLocal. I fully expect it to work out, or at least for management to show some positive results. Because deep down, the company is doing well. Yes, they're investing. Yes, it hurts margin in the short run. But once they're done with that investment phase, that will be reflected in the margins. And again, this is a fast-growing company, small in market cap, so the potential for a multi-bagger investment, potential. It's not guaranteed. It's potential. Could be there. Plus, if we look at other investments, small companies that are growing fast, usually they're not profitable. Usually they have a lot of debt. With dLocal, that's not the case. Again, execution is key. I fully know that. Yes, it is the 7th largest position in my portfolio because I have been dollar cost averaging. Now, let's see if that works out. Now, just because someone asked me last time we did this video, you wanted to see the watch list. This is a watch list that I haven't really changed that much since, well, a long time ago. So you still have these companies like Build-A-Bear, Duolingo, Sportradar, Genius, all of those on that list. That doesn't mean I'm following them. It's just I put them there once and it just stayed there. Now, the story, actually I could use an example here. So Duolingo, I put it on the watch list. It says it right here at $179. $100 later, Duolingo does not seem like a bad stock anymore, right? Does not seem like, oh, suddenly AI is going to destroy it, because that was the sentiment back then. That's why I added to the watch list, because there was that sentiment that, oh, OpenAI came out with a feature and suddenly everyone that's using Duolingo is not going to use it anymore, which again just shows you how irrational the market can be. And it doesn't just happen with companies like Duolingo. It happens with plenty of other companies, huge companies as well. So, for example, we have here CrowdStrike. CrowdStrike had a horrible event, right? For them, for the reputation of the company. And so, as you can see right here, the stock completely crashed. I think it was 40% or so. Now, by the way, just so you know, I added CrowdStrike on the watch list at $345. Now, this was at 1:53 p.m., so the market was not open, but this was the day the market would open and the stock would completely crash. But with CrowdStrike, you saw that crash, right? It reached $200 or so, pretty close to that, and now we're already at $285. Why is that? Uncertainty. These are things that can happen in the stock market as well. An extremely bad event for a company, bad repercussions can happen, right? Lawsuits, loss of clients, competition coming for their existing clients, etc., etc. And so the stock went down and it made sense. It was also a pretty expensive stock, it still is an expensive stock, but it is one that is best in class, which is why I'm not surprised to see that it's back up to $285 right now. No, I'm not surprised, because they've shown in their earnings report, and we've heard from the earnings call that, oh, actually the damage is not that bad. It's not that bad at all. Funny enough, I'm going to talk about CrowdStrike, I think, on Monday or so. So I'll leave that information for that video. But yeah, it's just to show you why I love investing. If you invest, you should love it as well. And of course, at the end of the day, what do we want? We want to see green. We want to see green and want to have green in the pockets. Let's be honest. We don't invest, or at least I'm not investing for the sake of investing, right? Oh, I'm investing because it's cool. Because I'm buying Tesla, because I'm part of the community, part of Palantir, of SoFi, of PayPal, and blah, blah, blah. No, it's nice. It's nice to make friends through that, etc., etc. But at the end of the day, this is what I started the video with. You do it because you want to make money. You do it so it secures probably your kids' future, can pay college, high school, have a good life, your family is settled, etc., etc. That's why you're doing it. Plus, you get to learn a ton of stuff. I've been investing since 2016, but I've taken it extremely serious in the last 5 years or so. Studying companies each and every day, looking at the companies. Sometimes it's bad because then you're overly obsessed with it, and then you see things that are not that important, but since you are looking at it each and every day, in your head it becomes important even though it's not, and then you overreact. So yeah, most of the times the best thing to do is just do nothing. Do nothing. But yeah, that's about it. I think I've talked about way too long in this video, but hopefully it's a different types of video, and hopefully you learned something. Hopefully I learned something from talking with myself here, but yeah, let me know if you think I'm completely crazy or not down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one. Bye bye.